Investors, as they're looking at the fixed income markets today, should feel a lot more comfortable than they were about a year ago, since real interest rates, which is the actual yield that you're buying minus inflation, is actually now positive, whereas about a year ago it was negative. So investors, the market has actually given investors a better return going forward than what they were able to get in the past. Given that yields have risen a lot and the yield curve has steepened between 2 years and say 10 years, investors should be more comfortable being in the intermediate than they were a year ago. I think short is also a good place to be, and credit is still a very attractive place to be, but investors should not feel that they need to move into the short aggressively given where yields are currently. Active ETFs have a number of headwinds that they'll face in the future. One of them is this front running, the idea that as they see with perfect transparency, investors are able to see what they're doing and might be able to front run the actual portfolio changes. So unless it's a very mechanistic kind of active ETF that's driven by other factors, it seems to me that it's going to be very difficult for active ETFs to get a lot of traction. And the other challenge is advisors are viewing it as the active piece, or the alpha, is being added by their model portfolios, and they want to use beta exposures to take those risk exposures. So active ETFs have a challenge there as well, because the model is really the model is really generating the alpha, not the beta slices that they're buying in the ETF space. So I think there are a number of headwinds that active ETFs will face in the future.